Finance Lab here. Let's be completely honest about what we're looking at. Uncertainty isn't just a buzzword to fill airtime right now. It is the literal technical description of the market. We are in a fog. Nobody knows how this geopolitical conflict resolves. Nobody knows what Friday's jobs number will do to the dollar. Nobody knows if the next headline out of the Gulf sends oil to $100 or back to $70. And in this kind of environment, patience isn't weakness. Patience is your only edge. Think of the market right now as a pressure test. It is actively searching for the cracks in your plan. If you're a short-term trader, this is critical. If your plan has any ambiguity, and I'll figure out the exit when I get there, or I'll just hold a little longer and see, this environment will find that crack, and it will wedge it open until your plan breaks. The people who survive conditions like these aren't the ones with the best macroeconomic thesis. They are the ones who knew exactly what they were going to do before the price moved, not after. So, before we dive into the data, and there is a lot of it today, ask yourself that hard question. Do you have a plan? Or do you just have a hope? Because I promise you, this market does not care about your hope. If you are prepared, not worried, and seeing this picture clearly and objectively, drop an OG in the comments. I read every single one. Alright, let's get into it. Silver. As I'm recording this, the paper price is sitting at $83. It pulled back from $86.90. But here's the thing. While the Western paper price tells you one story at $83, Shanghai is trading at $95. That's a $12 premium. The price on your screen is one narrative. The data underneath is a completely different one. Let's start with the COMEX open interest, because this is where the picture begins. Total open interest has fallen to 113,326 contracts. To put that in perspective, the all-time high was over 244,000 contracts back in February of 2020. What we're seeing right now is the lowest level of open interest since September of 2013. Think about that. The paper market, the very market that sets the price the whole world references, has lost more than half its players. The gamblers are walking out of the casino, and when a rigged casino loses its players, it loses its power to set the odds. Now layer this on top of that, COMEX silver total inventory is at a fresh one-year low, 352 million ounces. Nearly 3 million ounces left the exchange in a single day. In the last 30 days alone, over 53 million ounces have been drained. That's a 13% reduction in 1 month. The registered silver, the stuff that's actually available for delivery, sits at just 87 million ounces. And the leverage ratio? It's now 6.68 to 1. For every single ounce of physical silver sitting in that registered vault, there are 6.5 ounces of contractual obligations stacked on top of it. And that registered number is still falling. So next time someone tells you the physical market is fine, just ask them to explain a 6.68 leverage ratio at a one-year inventory low, with 3 million ounces walking out the door in a single session. In the delivery data, this is where it gets institutional. On Tuesday alone, 607 silver delivery notices were issued. Goldman issued 400 of them. On the stopping side, Bank of America stopped 195 contracts. JP Morgan stopped 145. Total March silver deliveries have now climbed to over 28 million ounces of physical metal being demanded through the formal delivery mechanism. This isn't retail stackers buying coins online. These are the big institutions going through the official COMEX process specifically to take physical silver off the exchange. On the gold side, it's the same story. Over 1,200 delivery notices, with Goldman and Wells Fargo issuing, and JP Morgan stopping the lion's share. They are not rolling over in the paper contracts. They are standing for their metal. Here's the piece that makes all those inventory numbers even sharper. Since February 9th, retail investors sold roughly 15 million ounces of physical silver. That selling should have eased the pressure. It should have. But it didn't. The 1-month silver lease rate, which in a healthy market should be near zero, is still elevated. The 1-year swap rate is still distorted, still pricing in backwardation risk. Retail liquidated 15 million ounces and the stress signals didn't even flinch. So here's the framing that matters. Paper markets haven't just failed to price in physical scarcity, they have actively prevented it. The very mechanism that sets the global price is the same mechanism that suppresses it. Now ask yourself, what happens when retail turns around and starts buying again? And then there's Shanghai. Silver inventories on the Shanghai Futures Exchange have fallen to 9.5 million ounces, with over 400,000 ounces withdrawn in a single day. At that rate, the SHFE would be empty in roughly 24 days. Combined, Chinese silver inventory is at its lowest level in a decade. And that Shanghai premium I mentioned? It survived the entire paper sell-off. Physical buyers in China are not transacting anywhere near the price your brokerage is showing you. So, the math is simple. Either silver trades significantly higher to bring in new inventory, or Chinese authorities are going to have to step in and halt withdrawals. There is no third option. Now, let's talk about Jane Street, because this is generating serious attention in trading circles. According to their latest 13F filing, Jane Street added 20.6 million shares of the iShares Silver Trust (SLV) in the fourth quarter. That's a 500-fold increase from the quarter before. The position is now worth about $1.3 billion, making them the largest reported holder of SLV, even larger than BlackRock, the fund's sponsor. Now, here's why this matters. More than 87% of Jane Street's portfolio is tied to options. They are structurally built to create and profit from volatility. So, when a firm with that architecture becomes the dominant equity holder in a physically backed silver ETF, the question everyone is asking is, which direction is the volatility bet? Because a 500-fold accumulation like that could be a massive long position. Or, it could be the other side of a structured trade, designed to profit from price suppression while holding the dominant paper stake. The custodian of SLV is JP Morgan, the same bank that paid $920 million in 2020 to settle federal charges related to 8 years of precious metals spoofing. That is not a conspiracy theory. That is a settled federal case. I'm not making an accusation, I'm just telling you what traders are talking about. They are identifying price action patterns in silver that resemble patterns previously flagged in Bitcoin, allegedly tied to Jane Street. That reportedly stopped appearing once the Terraform lawsuit became public. They've denied everything, and no US regulator has opened a formal investigation into silver yet. But the scrutiny is building, and the history makes it very difficult to ignore. Now, let's widen the frame, because silver doesn't exist in a vacuum. The energy picture converging right now is extraordinary. We have 3 simultaneous energy threats active as I record this. Hess-Kursk, Iran. Hess-Kursk, the Strait of Hormuz carries 20% of the world's oil. The Pentagon estimates the current conflict is costing $1 billion a day. Iran can produce cheap drones by the thousands, and Goldman has stated that if Hormuz volumes remain flat for just 5 more weeks, Brent likely hits $100. Hess, Qatar. Hess, 20% of the global LNG supply went offline today. Coal futures surged 7% immediately as the market priced in the pivot to alternatives. Hess, third, Russia. Putin has publicly raised the possibility of rerouting Russian gas away from Europe entirely. 3 simultaneous energy disruptions, oil, LNG, and pipeline gas all under pressure at the same time. WTI is at $75 right now, but Goldman's $100 projection only assumes the Hormuz disruption holds. It doesn't even price in Qatar and Russia at the same time. Study the 1970s. That's your blueprint. Energy shocks, geopolitical fragmentation, dollar credibility pressure, stagflation. Not because history repeats, but because the structure rhymes. Now, the honest resistance case. Silver pulled back from $86.90 to 83 cents. The dollar is consolidating. The lower time frames are choppy and unclear, and I'm not going to pretend otherwise. My plan from the last video hasn't changed. If the DXY finds follow through and closes above that January 15th level, expect more downward pressure on metals. That's the level to watch. Short term, the picture is genuinely unclear. There's no clean setup. Anyone telling you they have a high probability short-term trade right now is either dangerously overconfident or selling you something. Until the dollar resolves, stay away from short-term metals trading. In a genuine liquidity squeeze, forced liquidation hits everything, regardless of how good the fundamentals are. That risk is still on the table. These are conditions you respect, not fight. Thursday and Friday add another layer with jobs data. Consolidation before major releases often looks like accumulation, but it can resolve in either direction. Look at the price action across the board. It's choppy, directionless, whipsawing on headlines that reverse within the hour. That is not a trading environment. That is a minefield. If someone is telling you this is easy right now, if they're giving you clean setups and high confidence calls in this fog, they are selling something. Nobody has certainty here. Long-term stackers, your job is to watch the lease rates, the delivery notices, the SHFE withdrawal rate, and the Shanghai premium. Those are the real instruments. The paper price is just the noise. Short-term traders, if you don't have a specific edge, with a specific entry and exit in both directions, on a specific time frame, you are not trading this market. You are gambling in it. And this market right now will find every weakness in your plan and exploit it. The ones who survive aren't the ones with the best thesis. They're the ones who knew exactly what they were doing before the price moved. Invest with logic, not hype. Finance Lab out.